Everyone, welcome. Welcome to the Brink Pitch Prep. Come on in. We've been waiting in the waiting room. So we got expecting a big crowd tonight here at the Zoom. So thank you everyone for taking an interest in our program and making the Brink part of your entrepreneurial journey. Seeing a lot of the same people come into the prep events and then some of the other investor readiness events that we've had. So, and the SBIR events. So great to see your dedication to our training events. All right, so Stephen's letting people in the room. I'm going to go ahead. First of all, I guess a little bit of housekeeping. If you want to like update your name, you can hover over your face in your square and go to those three dots and change your name to something that you want everyone to know who you are, like your company name, your full name, so they can find you on LinkedIn. And then of course use the chat in this introductory time to make a very small little pitch or ask or whatever. This is the networking that we'll try to get going on Zoom. So use those functions to update your name and then use the chat as well. So I'm going to go ahead and this is being recorded. Stephen will send out the recording tomorrow or soon after. Share my slides. Where are they? There. Oops, that's not it. That's a grant I'm writing. Let's try this again. Here it is. All right. No, this needs to be where it's called. Can anyone see that? I clicked on the wrong thing.
We can see pitch prep.
Yeah, it's supposed to be view slideshow. There it is. I'm in I got some like medical stuff, and so my brain's a little foggy, so work with me. Apologize for that. Okay, so I'm gonna do a quick little intro, get us all oriented on why we're here. So welcome to the Pitch Prep for SDAC. This is a weekly series to help founders prepare to pitch investors. You don't have to go to apply to SDAC. You can attend these events and not apply to SDAC. Of course, you can apply to SDAC and not attend these events. You can do whatever you want. You're entrepreneurs. We know you're gonna do that anyway. So there are no rules. But last year we did 15 weeks of this. It was called E-Track. This year, just because of the way the deadline for the application moved, we only get 8 weeks of this. So we appreciate your loyalty and working with us also in this winter quarter, so to speak. We don't usually run at the program. So tonight I'm real excited. We're going to focus on the financials and the ask, and we've got some great speakers, Randy Schreckheis and Kit Ryan from Pillsbury, and I will introduce them before they give their presentations. So first of all, I just want to recognize our partners. We are part of a big ecosystem of entrepreneur support providers in San Diego. You've got some angel investment funds, some tech, clean tech, a lot of partners that we co-host events and we share each other's, we co-promote events for each other. So it's great to be part of a really tight-knit network like this. Of course, I want to recognize my grant funders, the reason why I'm here. Of course, we have a federal grant with the Small Business Administration. We have another one that called the Regional Innovation Cluster, and another federal grant from the Economic Development Agency. And then we also have some great funding from the state of California. We're also one of the Accelerate hubs, one of 13. So really excited and proud to have such a well-funded organization. And sometimes we have representatives from these funding entities attend our events, like Lucy Montgomery and Stephanie Garcia. I haven't checked to see if they're on here, but they're a great source of information if you have any questions about startups and resources, and they're great connectors. Okay, so back to kind of the ecosystem, this great ecosystem that we're so fortunate to have here in San Diego. This sort of is developed by Startup San Diego. It's their image that I'm using, but it sort of takes you through this the organizations that focus on earlier stage to what I love, the crushing it, because we're in SoCal and that's how we talk. So definitely take advantage of what everybody has to offer, find the best fit, attend them all, pick and choose what really works for you. So today, after I'm done with my overview, I have 2 minutes. We're going to interview. Randy's going to talk about financials. We'll have a small little break, and then we'll bring on Kit Ryan, and we'll try to end at 7:30. And so I'm just going to go over the little things here on the right. So first, just to make sure this is sort of my elevator pitch, or my positioning statement. The Brink SBDC provides free and confidential one-on-one advising and training to help innovative founders access capital so they can build investable companies. But really, based on what those grant providers are funding us for, they want us to help you make economic impact. So like create jobs, create revenue, so that we have a vibrant San Diego. So that's why we're all here. And just sort of kind of delineate between what the Brink is and what the San Diego Angel Conference is. We're all about founders. We are all about, our grant funding is all about helping founders start and grow their businesses. So that's why we do the Brink pitch prep. But the Angel Conference is about activating angel investors and then connecting those investors to founders, making connections, and of course then funding the founders. So when they activate angels in the area, because of the Reg D crowdfunding, they can raise a fund of like, say, a minimum of 200,000, but because everybody pitches in and buys a unit, and that gets awarded to who they vote for as the winner. And I should actually be remiss if I didn't mention, I will in the introduction, but Kit Ryan is one of the co-fund managers of the upcoming San Diego Angel Conference. So really lucky to have him here. So listen to what he says. All right, so just to, where are we in the series? We still have next week, we're going to do competition in IP. That's going to be in person at USD. We're really lucky. We're going to have Misty Kane from Techstars talking about competition, and Noella Gillespie from Procopio, IP attorney, is going to be talking about IP strategies. And then you can see the rest of the topics, and you can actually, if you just scan this QR code, or Stephen will put it in the chat, you can find registration links for all these. We actually, even after the application deadline, we've added on some other more specific pitch prepping, like actual prepping the whole entire deck. So we keep adding things on. We have a lot of people who want to present to you, and so we're lucky to have that. Okay, so January and February is the pitch prep. The application deadline is February 28th. Yeah, deadline 27th. And then that's when the iTrack starts, was the investor track. So March is when they're going to be reviewing all the applications. Then in April, they're going to invite the ones that they vote for to come in and do the 3 and 10-minute pitches. That's what's going to happen in April. And then May, they're going to finalize 6 finalists, and they're going to do due diligence on those 6 finalists. And then those 6 will present on June 6th, 5th, at the SDAC finale over at San Diego State University. So that's kind of the high level view. The application portal is open, so you can scan this fuzzy link, or I think Stephen can put one in the chat. You can apply now. I think they've received 7 applications. It's a little early. You don't have to apply now, but of course, be a good planner and don't push it to the last minute. Just so you know, we have a lot of other training events that we offer. Our 9-week accelerator called Lean Essential Sprint. We have a lot of events about the SBIR, and of course, we offer legal office hours with Kit Ryan. So he's like a big part of what we're doing here at the Brink. But of course, our big centerpiece to it all is the free one-on-one advising. That's really what we do. And the events are fun to just kind of get awareness, and I'll train you guys too. But this is really, we'd love for you to become a client, and then we can provide you advising and kind of guide you through your entrepreneurial journey. Here's how you do it. Steve can put a link in the chat. This is how you register advising. We have another, if you go and look at the other workshops, we have other non-pitch prep workshops. Sylvia Ma has created a series of workshops that we've called Investor Readiness. So, and then we'll kick off Lean Essential Sprint again in June, because this session is already ongoing and it's very full. All right, finally, this is almost my last slide. So I want everyone to come to our pitch decon on February 26th. It's going to be at USD, and all you got to do is get up in front of everybody and just do your 1-minute pitch. And here's a little, like, this Benton Moore, one of our Brink advisors, put this little tip together, kind of organize how you're going to say it. So you go up and do your 1-minute pitch, and then you get feedback from, oh yeah, the judges are all going to be SDAC investors. So you need to be there so you can meet them. And then if you really have your act together and you have your 3-minute slides ready, then put your name on the board, and we're going to vote for like 3 to 5 companies that come back, do a 3-minute pitch, and then you get Q&A. You get feedback from the investors in front of everybody, so everyone learns. So it's a safe space. So if you really are got it all together, come with your 1-minute pitch, come with your 3-minute slides, and you might get a chance to present to the SDAC investors and then get some feedback from them. And then you can apply the next day. So that's pretty cool. So if you haven't already, please follow us on LinkedIn. That's how you know about all those events. You don't have to write them down. They'll come up in your feed. So with that, I will end it, and I will introduce Randy Shrek Eyes. So really excited to have Randy here. Randy's a Brink advisor, but he has so many more skills and talents and experiences. Randy actually he worked at the bench, got that cred. He's a scientist, but he's somehow migrated over to the finance field. And he takes on, now he's a CFO, he works in that capacity at biotech companies in San Diego and throughout California. So we're really lucky to have Randy here. He's going to talk about financials. So let's give a big digital round of applause for Randy Shrek Eyes. Whee! All right, take it away. You can go up and upload your slides.
Okay, sounds good. Oh, dear. I think this is one of those embarrassing moments where I go to share my slides and realize that it seems like I'm not able to. Oh dear.
Well, I just shared my wrong slides in front of everybody.
Let's see if this works. Sorry, I got a new computer.
That's all right.
Oh, okay.
Meanwhile, I'm going to go look at the chat. That looks all lit up over there.
Okay, I think we're good now. Sorry about that.
All right.
I'm going to go ahead and get into presentation mode. So as Amy mentioned, I'm Randy Schreckeis, and just a little bit more about my background. As Amy mentioned, I started my career as a molecular biologist at the bench. Did that for about 8 years, and then had the unique experience of joining a company right as they were about to do an IPO, and that's when I realized that I was really interested in finance. I've been doing that now for, I guess about 19 or 20 years post business school. A lot of my initial experience in finance was at bigger companies. So I've worked at 6 publicly traded companies. Along the way, I co-founded a company called August Therapeutics. I helped a friend start a company and kind of got the startup bug. And so more recently, my last position, I was head of finance for a Series B stage biotech company in the Bay Area that had raised about $100 million in total. More recently, I joined a company here in San Diego area called Protillion Biosciences. It's a Series A stage company. And then I'd be remiss if I didn't also sort of put a plug in for SDEE, the San Diego Entrepreneurs Exchange, where I actually know Amy from. I'm a past president and also currently serve on the board there. So that's a little bit about my background. I'm going to sort of go through some quick basics of finance just to make sure everybody's on the page, some basic concepts and ideas, and then kind of go into some topics around budgeting and how to build some financial statements, particularly the P&L or profit and loss statement. So I always kind of start with this because people always kind of tend to lump accounting and finance together. My background actually is from the financial planning and analysis standpoint, so I'm not a CPA or an accountant. And I had a boss at one point that always used to point out that accounting's all about the past. It's about how you capture financials and create statements from them. This is particularly important if you're at a publicly traded company. We're in a post Sarbanes-Oxley world. There's very specific rules and regulations about how you report your financials. And then on the other hand, the sort of role of finance or broadly financial planning and analysis is more about really the future and incorporates things like budgeting and forecasting and long-range planning. Also thinking about how to manage cash and at larger companies' investments in M&A and things about that, like that. So I guess as a startup, the question is, why should you care about accounting? At some point, you're going to have to get good at it or at least build a capacity to do it. And this is important because investors are going to want to know how you've been spending their money and that you've been spending it effectively. And I think it's maybe a little bit obvious, but as an entrepreneur, you also want to be caring about finance because it's really, again, about the future, and you've got to have a solid plan to demonstrate to your investors that you're going to implement it in an efficient and careful way. Just some quick basics about accounting, and this is important because you hear a lot about again, Sarbanes-Oxley, GAAP financials. What does that all mean? Well, it turns out there's really two ways of accounting. If you're a small, early stage startup, you're probably going to want to choose a simple method of accounting, and that's the cash-based method. The alternative to that is an accrual-based method, which I've tried to illustrate what an accrual means. And actually, it can be a little bit of a challenging concept to wrap your mind around. And it's really this idea that there's a difference between spending money and essentially committing to an expense. And so the best illustration of this is the car wash example, where if you want to get your car washed, you could either go out and, get it done for at one time and pay like $10, or you could buy like a coupon book and pay $100. And so with the cash-based accounting method, you would recognize $100 of expenses when you buy the coupon book, because that's when you're essentially handed over the cash. But sort of complicate things from an accrual standpoint, you actually wouldn't recognize $100 when you buy the packet. You would wait until you get your first car wash and you'd recognize $10 of expense, and so on and so forth. And again, I don't want to get too hung up on this, but it's important to recognize that there is a difference, and it has an impact on how you build your budget or forecast and how you present your information to investors. So some quick basics on accounting function. We've probably all, at least heard of this, if not interacted with people that have this functions, or in some cases may have performed these functions. From the startup standpoint, the ones that you're going to have to sort of pay attention to are the accounts payable, paying your vendors, so to speak, paying employees, that's a payroll function, and just kind of broadly, any of the activities related to tracking transactions is referred to as bookkeeping. If you're lucky enough, well, everybody in California has to do taxes, but if you're lucky enough to post a profit, then you have to pay essentially sales tax, or you have to pay taxes on the revenue that you're recognizing. And then there's some other things related to financial statements. You've probably all heard about income statements, statement of cash flows, the balance sheet. And at some point you're going to want to put these together for investors. But what I like to do, even at larger companies, is I've worked with a hybrid sort of spreadsheet or document, which is referred to as a P&L, or a profit and loss statement. And that's really a hybrid of the three statements above. It's like the income statement because it gets you to net income. It's sort of like a statement of cash flow because it tracks how your cash changes from period to period. And then it's like a balance sheet because it tells you how much cash you're going to have. If it's a past P&L, it'll tell you how much you've had in the past periods. But this is really important because this is sort of how you're going to set up your plan to illustrate to investors how you're going to implement the money that they're giving you as investors, put it to work, and how much money you're going to have in order to achieve and recognize certain milestones in the future. A couple other sort of accounting related functions that I'm not going to really go into too much. From a startup standpoint, once you get rolling, if you've had the opportunity to start your company, there's a couple of ways to deal with accounting. When I was an entrepreneur and when I was helping a friend start a company, I did the bookkeeping just because I had that experience. And it saved the company quite a bit of money because we didn't have to pay somebody else to do it. The downside is that accounting can kind of be an esoteric sort of like foreign language to a lot of people. So if you can find a good bookkeeper who can work a couple hours a week for you, that could be a good option if they're affordable. I've used QuickBooks in the past. It's pretty intuitive, especially if you have a background in basically anything related to spreadsheets. It's pretty easy to learn. But it does get complicated once your financials become a little bit more complicated. So, I think for most people, starting in QuickBooks is okay. It's hard to screw up, but once you become a little bit more sophisticated or the company grows, then think about getting a bookkeeper. Moving on to the finance functions, I've already mentioned a few of these. So the budgeting and forecasting, we're going to kind of really get to the meat of that today in some examples, but there's other sort of functions that people in finance roles do, things like treasury, which is essentially assuming that you have enough cash, you have to manage that. But really, I think the important thing, again, for from a financial planning standpoint, is that you need to demonstrate to your investors that you have a pretty solid plan, and that you're not going to run out of money before you get there. So when it comes to building a budget, there's a couple different approaches. The top-down approach is basically saying, I've got, in this example, $10 million, and I need to figure out how to spend it. So I'm going to assign it to different activities, and that works if you're a really big company. And actually, the Fortune 500 companies probably tend to do this, that they know that they're going to have, like $1 billion operating budget, and they need to figure out how to implement it. But for startups, that's, of course, it's not likely to happen. And you're better off with a bottoms-up approach, where you basically have an objective that you're trying to achieve, and you need to figure out how much money it's going to take to get that done in a particular time. And that might be a year, it might be 2 years, or it might be, monthly. So again, what's right for startups? I tend to favor the bottoms up approach. And the objective, again, is to figure out how much money it's going to take to get to specific milestones. And when I talk about milestones, I'm not necessarily talking about things that, are just box checking activities. They're actual value inflection points or value increasing activities for the company. And that could be, if you're, in a software startup, coming up with a prototype. Could be, in my world, in the biotech world, that you're going to have some really compelling data that you think is going to, be important for investors to see. So I think one of the things that I forgot to mention about my background is that in between working at the bench and going into finance, I spent a couple years in project management. And so I became a big fan of Gantt charts and basically, kind of mapping out timelines and activities. And I found these to be really useful for helping build a budget. And I'll get into that a little bit later. So everybody take a big deep breath. This is an example of a P&L. It looks a little bit hairy. And actually, I should say that if anybody's interested, I built a spreadsheet for the purpose of this presentation. And so if anybody wants this, I can put my USD email in the chat when I'm finished, and you can reach out to me. I'd be happy to send that to you. I think there's plans to distribute the slides. But the idea of this particular P&L is that it's yearly. It's obviously all made up, but it starts with product revenue at the top. And, I haven't really defined what this company is, but we're, planning to sell something. We're basically going to collect revenue from licenses, and we might have some government grants along the way. So that's the total revenue line at the top. The next line is the cost of goods sold. That's basically any activity that's directly related to product sales. And so, in this example, if we were selling widgets, it would be, the cost of manufacturing the widgets and any salaries that are directly related to the production, marketing, and sales of that. Um, the operating expenses are down below. And this is where, as a entrepreneur, you have to be, I guess, a little bit creative about how you come up with some of these estimates, both for the revenues, the COGS, and the salaries. And I'm going to go into that in a few more slides here. But essentially, if you take the revenues less the cost of goods sold, that'll get you to the gross profit. You basically subtract the total expenses from the gross profit to get your earnings before taxes. And I mentioned that if you're lucky enough to have positive revenues, that means that you're going to have to pay taxes. 25% to the federal government's probably a pretty good estimate, and that takes you to net income. And so one of the things that I kind of glossed over here is that this particular P&L, I'm assuming it's cash based, but if you were to do an accrual based P&L, you would actually have one additional line below this, and that's the change in working capital. So if anybody's like a really, if somebody's got a background in finance, just keep that in mind. I think for the case of the entrepreneur, getting to net income is fine. The change in working capital has to do with the difference between when you essentially recognize a revenue or expense and when you actually either receive the payment or make the payment. And that's, like an issue if you've got a vendor that wants to be paid in 30 days or, you're collecting revenue and you don't get paid for 60 days. That's where that adjustment happens. But for our purposes, I think net income is good enough. In this case, I've essentially assumed that we're starting with $5 million and then basically going from year to year, I have the starting cash and I, either subtract out or add in the net income going from 2025 to 2034. And, I've got to say that things look pretty good here. Getting to, $234 million of cash in 2034. So this is the example. So getting into a little bit more of the details around revenue, I think this is, quite frankly, for companies that are going to be, more cash-based and generating revenue early on, this can be one of the challenges in terms of figuring out how you're going to communicate to investors what your revenue is going to be. And really, you've got to think about when the product launches, and one method is to kind of think about specific percent increases over the years. This might not hold a lot of weight with investors because you're probably launching a unique product and kind of pulling numbers out of the air. I'm going to come back to that in a minute. Another method is comparables or comps. Look at something that's already on the market, and if you're able to find A, their revenue numbers, or B, sort of what their uptake or year-over-year increase is per year, then you can kind of model that. And there's a couple sources of information where you may be able to sort of track down these revenues. So the publicly traded companies have to file their quarterly 10Qs and annual reports 10Ks with the SEC. And if they don't sell a lot of different products, you might be able to kind of look into that and get an idea or estimate what, comparable products that you're going to be selling are selling each year, a quarter, or month. And then for some reason, some private companies will, in their press releases when they announce financings, talk about sales numbers or number of customers. And that's also a potential source of information. The cost of goods, I think the point that I want to make here is that first, if you're not selling anything, you're not recognizing any COGS or cost of goods sold. And I think this is something that confuses people. You actually don't recognize any COGS until you start selling the product, even if you start manufacturing it a year before. You expense it before then. But really, the easiest way to deal with the COGS estimation is to essentially try to figure out what you're going to sell the product for, how much it costs to make the product, and then come up with a percentage. So that percentage reflects, the cost of manufacturing, and just apply that year over year. You may assume that as you sort of ramp up sales, you might become more efficient at making things, so your COGS actually go down as a percentage of sales year over year, or you may do things like raise the price of your product without having to increase the cost of manufacturing it. So the year over year percent of COGS may go down over time as well. So coming back to the expenses, and again, this is where you need to get a little bit creative. Probably the largest expense for any startup, at least initially, is going to be the people. And this is where the sort of project management tools kind of come in handy, where you're thinking about all the specific activities that you need to accomplish. You can think about the number of people that you're going to need to accomplish those tasks. And then you can do things like you can estimate actual salaries and apply a multiplier to come up with the benefit costs. Sort of an industry standard for that is that a person plus 30% is going to cover them and their benefits, or you can just take a company average, which is something that I've done in the past that tends to simplify things. And so in this case, I've just estimated that it's going to take 10 people a year to accomplish something. The cost is $150,000 per year. For their salaries, adding in 30% for benefits gets me to almost $2 million. For a lot of startups, the next most expensive item in the budget is going to be rent. If you think about this from a capacity standpoint, you can kind of estimate a certain number of square feet that you're going to need per people. For office space, that tends to be about 200 square feet per person. You can kind of try to pack people in, at least initially when you're a startup, to save money. But again, this can be variable by industry. There's some metrics available. If you have questions about that, feel free to ask me. And then come up with an average dollar per square foot per month. In San Diego, I think office space may be as high as $5 per square foot, although it's probably come down since the pandemic, since the demand for office space is so high. And of course, the other option is that if everybody's remote, you don't have to pay for the rent. So that's something to keep in mind as well. And then from there, once you've established the number of people that you have, you can think about the other expenses, in particular things like office supplies or computers, as a certain cost per person per month. And that's a pretty good estimation as well. So I've been trying to hammer this message home, but there's really kind of two different types of investors. There's sort of the more cash-focused investors that might be investing in certain industries or areas where you're going to be generating revenue sooner than something like again, the world I live in, which is biotech, where once you start working on for example, a drug, you might be lucky if it launches in 15 years. So that's more of a value-based investor where they're looking at increases in valuations versus a cash-based investor who's really looking at what your cash flow is going to be like. And so I think probably one of the questions you'll get asked, maybe from some of the judges, if you're going to participate in any of the SDAC stuff, is when are you going to become profitable? And I think there's probably really easy to think about an answer being, better when it's sooner. But you also need to think about that if you can maybe, if there's an opportunity to make additional investments to, improve your product or generate, a larger customer base in the future, delaying profitability actually might be better for the business. So don't get stuck in that trap. Going back to that simple or sample P&L that I provided earlier, it's pretty clear here the way that we've built the revenue and the COGS and expenses. We actually end up becoming profitable in 2026, and that sounds pretty good. But I think the thing to kind of point out here is that I've increased the revenue 80% year over year, and there's probably not a lot of products that do that, but I did it for a specific reason, and I'm gonna come back to that. So if you're, again, in an industry or area where investors are looking for potentially a higher return as your, valuations increase over time, the biggest question that then these investors are going to have is, what's my return on investment like, and when do I get my money back? Again, in my world, where a lot of the venture investors will raise funds that have a 10-year lifespan, they'll probably start investing out of those funds during the first 2 or 3 years, which means that they want their money back in 6 to 7 years, and they want a tenfold increase in value. So, couple things that are on this slide, but it's actually uh, illustrated on the next slide, which is again going back to our sample P&L. There's this idea of return on investment, which is actually a pretty simple calculation, which is the future value divided by the investment. And in this case, I've essentially assumed that the investors in 2027 are going to look at the value of the company. They're going to use a formula that's known as net present value, which is essentially taking the net income from 2027 to 2034 and discounting that based on time and a 15% discount rate, and then adding up all those numbers. And if you do that calculation in the spreadsheet, it turns out that the net present value is about $100 million. In this example, I told you before that we were going to take $5 million in 2025. And what I didn't tell you is that we were going to sell 50% of the company. And so this means that the portion of the company that the investors own ends up being $50 million, which 50 million divided by 5 is 10. So we've magically hit that 10x increase in value, and the investors are quite happy. So a couple of things that I wanted to point out here. Number one, as a finance person, return on investment, even though investors favor it, is not one of my preferred benchmarks. There's a couple technical issues with it. The second thing is that if you build a budget and you apply a net present value in 2027, as a founder, if you're a sole founder, it doesn't mean that you're actually worth $50 million, because there's really no, at this point, clear path to liquidity or you're an exit. So I've seen some people that have applied net present values to their companies, and it's all based on speculative future cash flows. And if an investor asks you what you think your value is, it's essentially a negotiation, because they're going to have their own takes on your revenue assumptions, your expense assumptions, and I think the name of the game when it comes to raising money is sometimes investors will try to negotiate you down. One of my favorite quotes as a finance person is from Warren Buffett, which was on the previous slide, and it's beware of geeks bearing formulas. And that's just, sometimes, especially me spending a lot of time in front of a spreadsheet, it's easy to build a really complex model, but sometimes you got to take a step back and say, does this make any sense? And so this leads me to my next point. Is your plan reasonable? As you build it, you've got to make it represent what you think is the most reasonable, even though part of being an entrepreneur requires us to be promotional. We have to sell our ideas, we have to sell products. You have to really assess whether or not this is something that you think makes sense and that you can defend to investors. And it's not just investors. You actually have to sell it to yourself. Becoming an entrepreneur is a really big step. I can attest to that, having gone for a few years without receiving a salary and dealing with the stress of thinking about whether or not we were going to run out of money. But you also have to be able to sell this sort of idea and the value of what you're doing to your co-founders, to your employees, and in some cases, in my case, to a spouse or a partner. So with that, I'll say that when you're building these models, it's always a good idea to kind of create variations once you get the model to a place where you think it's fairly good, and that's doing things like increasing or decreasing the revenue like 20%. You can do that to COGS and expenses. And when you do that, it's important to see how it changes the model and what your cash balance is going to be. And this is sometimes referred to as sensitivity analysis, and it's just a way of kind of pressure testing your assumptions. And so speaking of assumptions, it's always really important to be really clear about what those assumptions are, especially if you've got a pretty aggressive revenue forecast like I used in this sample, and communicate that to your investors because they're actually gonna ask about it at some point. So not to overwhelm everybody, but I've taken a pretty complex example, which is again in my world, which is biotech drug development, where I've tried to lay out some assumptions on this slide, but really the next slide I think is kind of the roadmap or the key to what I described earlier from a timeline or Gantt chart standpoint, where I've tried to lay out what I think all the important activities are. Those are sort of in the purple or magenta bar arrows here, along with different milestones along the way, which are sort of the red triangles. Some of them are labeled and some of them aren't. And then I've taken things like FTE estimations. I've assigned what I think each activity is going to cost, and I've kind of spread it out over time and then added up in half-yearly increments here. And this is really important because this, or I think it's an important slide anyway, because it answers the question that investors have about how much is it going to cost me to get to a certain point in terms of the milestones, which again are the valuation inflection points. And then, you can sort of layer on top of this the net present values and be able to say, well, I think when we get to this first IND milestone in 2025 that we're going to have spent $20 million, but we're going to increase the value of the company like $100 million. And so this is a good roadmap. This really becomes sort of the way that you put together a budget. In this example, it ends up going out 4 years, but you could do this for, the first year that the company is going to be launched. So with that, I think I've finished maybe a few minutes early, but I'm certainly happy to take any questions. And as I mentioned, I'm going to go ahead and look back at the chat and.
Yeah, thank you, Randy. Why don't we, there were a lot of questions in the chat, but why don't we, they're going to raise their hands.
Yep.
Which is going to put them in a queue. So why don't we start with Shannon? And if you have a question in the chat, just raise your hand. It'd be easier that way. So go ahead, Shannon, if you unmute yourself.
Okay. Thank you. Yeah. Can you hear me? Okay. I have headphones in.
Yep.
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 Okay. My question is related to the Gantt chart at the end.
Yeah.
And the estimation of these timelines. I'm asking because I have kind of done something like this before, but it turns out that my estimation of when it will get to these milestones isn't always correct.
Mm-hmm.
And so do you have any advice on mapping these out?
I do, yeah. So I've worked with some people in the past that they say, oh, we'll pad things. We'll pad the timelines or we'll pad the budget. And I think that probably offends both the project manager and the finance guy in me. And that's because if you're overestimating how long it's going to take to do things, that's time that could be spent doing something else. And sort of the other side of that is that even if you come up with realistic expectations, the truth of it is that your investors are probably going to want you to do it faster.
Okay.
So you've kind of be able to, trade activities as it happens, but you need to be, really transparent about your estimations that, they may change. And if they do change, you're going to have to do some dollar swapping. And that's the other component, is that when people overestimate the amount of money it's going to take to do something, in this case, it likely means that you're going to have to raise more money than you need. And I don't know that there's any easy amount of money to raise, but I will say that from my experience, raising more money is hard or harder. So if you increase a 50%, if you increase 50% on your ask, it might be 100% harder to raise that amount of money. So, I will say that I actually put this together, this chart together for a job interview. And I did a lot of research, but I also knew people that worked in the industry. And so I reached out to them and I said, what's a good estimate for how long this is going to take or how much this is going to cost? So I think that's one thing that I'll say, that over the years, getting back to the Warren Buffett quote, anybody can build a model, but it takes really good information to build a good budget. And that means, in the case of working at a big company, you have to reach out to pretty much everybody in the company and get their input. If you're an entrepreneur, that's a little bit challenging, but just essentially in general, getting more data, I think, is the key there.
Okay, so more so like who, not how, asking as many who's as you can,
Yeah,
and then
yeah.
trying to triangulate that.
Yeah, and you can even ask investors. This isn't necessarily going to work for SDAC, but I think as the saying goes, if you're looking for money, ask for advice, and if you're looking for money, no, if you're looking for money, ask for advice, and if you're looking for advice, ask for money. So,
Okay.
so the company that I started, I had probably the bad fortune of pitching a really large Boston-based venture fund first. And looking back, I really wish that I would have pitched some fourth tier investors to get their feedback first. I think and then that's also, it's part of the deal, is that your pitch and your plan is going to change over time, and hopefully it gets better.
Okay, thank you.
You bet.
All right. Next question from Sue B.
Thanks, Emmy. Hi,
Yeah.
Randy. Great presentation. So I have a question similar to the previous one.
Yeah.
Is there any example of a good financial model that early stage biotech can build that can help project their market size, number one, number two, investment returns, and number three, the company valuation?
There's probably not really anything that's freely available. If you're working in biotech, you may know Peter Kolczynski, who
Yeah.
is a
RA
managing
Capital.
partner, RA Capital. He actually wrote a book. It's free as a PDF if you go to the website and register, and it talks about a lot of these things. Getting the details around the market growth is a little bit challenging. Is it a diagnostic or a therapeutic or something else?
Therapeutic.
Yeah, if it's a therapeutic, um, there are actually models for that. I happen to have one. I built that for another job interview like 15 years ago. And it gets into a little bit of detail, but if you want to, I put my email here. Again, Amy mentioned this. I'm an advisor at the Brink, so if
Yep.
you've got really complex questions, set up a session, and I'm happy to talk about it then.
Sounds great. Thanks.
You bet.
All right, Hari, you're next.
Okay, Randy, excellent presentation.
Thank you.
My question is on slide 18, just like the other two.
Okay.
people.
Yeah.
In the beginning, you mentioned compelling data as
Right.
opposed to a product, a prototype.
Right.
And the reason I'm asking this question is I am in medical devices startup, and it includes both screening, diagnosis, and intervention.
Mhm.
And it's FDA and all of those things. So
Right.
all these blue things that you mentioned,
Yeah.
I was hoping there is a document, or maybe you can talk about them. Like, what are these compelling data that I can use as I untangle the FDA things and what the predicate devices are doing? And
Yeah.
how disruptive should I be if mine is completely disruptive? Because
Yeah.
people don't like disruptive technology in healthcare.
Right. Well, I would say that maybe the users and insurance companies don't, but investors tend to like it because if it's disruptive, then it can be a much larger return on their investment. I will say that when I built this slide, I've been a project manager and I've been working in biotech now for 26 years. So this was a lot of just of my experience. And I'll say that some of the numbers here are not really very accurate, really anymore. So I don't really think there's a magic bullet, but again, there are some resources available. I don't know for medical devices or diagnostics, good sources of information. But I will say that if you reach out to some CROs if you're nice, they might be able to provide you some information without actually becoming a customer, with the hope that you will someday become a customer. So, for example, if I wanted to think about a clinical study and I didn't know what enrollment was like in a specific indication, I might email someone I know, ask them the question, and say, "Hey, I'm trying to raise some money. Can you help me out here? If things go well, I'll get back to you," kind of thing.
Actually, my question was not so much on the dollar numbers,
Yeah.
on these blue things. It
Yeah.
was more trying to decipher some of the acronyms in there so that
Okay.
I could apply them to a different field. Like in my
I
case,
see.
it's
Yeah.
hearing loss.
Uh-huh. I see. So the acronyms like PD, Form 80, stuff like that, is that what you're asking?
Yeah, because FDA has all of these for
Right.
devices and pharma. And I
Yeah.
just need to figure out the devices lingo.
Yeah. Well, I think the FDA has a website where they talk about some of the nomenclature. I'll have to track it down. I've seen a couple other sources on the internet, but again, that's specific for drugs, not for devices or diagnostics. Yeah.
Thank you.
You bet.
I really enjoyed your presentation. Thanks again.
Oh, thanks. You bet.
All right, Remy.
Hi, great presentation, Randy. My question was around, do you know of any online resources in terms of platforms for building and managing the Performa, and specifically for SaaS?
For SaaS, there's like financial planning and analysis, like Society. I think they have something similar to what I built, it turns out. And I think it's free if you register, but it ends up being a spreadsheet, and it's not really a software package. I think once you get to the software packages, you can do budgeting and things like QuickBooks. And I think one of the benefits of doing that is that if you enter a budget in something like QuickBooks, which again is not free, it'll be able to produce all the financial statements, including the balance sheet, the statement of cash flow, and
Yeah,
income statement.
yeah, I'm familiar with that piece of it, but this is more
Yeah.
from, to manage projections and like some of the ones we've tested out, like have dashboards and which
Yeah.
are helpful, especially with investors and compliance and reporting, and
Yeah.
it can tie in the QuickBooks piece, but we're looking for something that's just more intuitive than downloading a spreadsheet, and working the spreadsheet.
Yeah. I mean,
just might be easier.
unfortunately, I don't know anything that's super economical. I've used some databases like that. I mean, probably the most popular in my industry is NetSuite, and there's some plugins that sit over NetSuite that are probably going to cost, anywhere from like $100,000 to $1 million a year to license.
Yeah, no, we're not, obviously not in that part.
But you never know. Things are changing. There's always, startups that are coming up with new ideas that might have something that you can beta test. It sounds like you've already done that. But again, if you have,
Yeah, I was
additional.
just curious, yeah, if there was any that you knew of that just overall, because we've been doing the free trials on some of them, and they're actually pretty affordable. But it's just so much easier. And I'm saying this because I learned a hard lesson with my first startup where we hired somebody to do the projections for us, and it was like thousands of dollars, right? And
Oh, really?
oh my God, it was ridiculous.
I've got to get into the scam.
Yeah, and then in my current company, my co-founder is a finance guy, so
Oh, that's great. Yeah.
yeah, but now I'm launching something else, and
Yeah.
we're both not spreadsheet numbers people, and so we want something that would just make it easier for us.
Yeah. I mean, I will say that it does take some development of skills, but I also think that they'll become useful, especially if you have any sort of technical background. Learning Excel can be like programming a little bit, but I think it's a good skill to have, because if you're going to be managing a company, even if somebody else is doing the financials, it's like, good to know, I think. Good.
Oh, I get that part of it. It's about time and efficiency. That's all.
Yeah, and I'm here to tell you that sitting in front of a spreadsheet for like 12 hours a day is not awesome.
Yeah, I know my strengths. All right, thanks.
You bet.
All right, so we have a few minutes left. We'll go with Kabir.
Hey, Randy. Hi, Amy. Randy, thanks for the very informative presentation.
You bet.
Two quick questions. In terms of a P&L that's compelling or realistic, how do you not pad, but
Yeah.
add contingencies or scenarios without overcomplicating the model?
Yeah.
And I'm asking because we're a med device company, and there's always needs to be budgetary contingencies for FDA delays,
Right.
clinical studies, et cetera.
Right. Yeah. So the easiest way to do it is actually to build out a full model. And if you do it like I created my P&L, that's just one tab of a spreadsheet. Easiest thing to do is to create another tab, duplicate it, and then start changing some of the ways that it works. If it ends up being a more complicated spreadsheet, then essentially you can just create another version of the model and start modifying it that way. I mean, I will say that if you've got a lot of variations, you know, you can end up with multiple different, you know, versions of the model. It might get confusing, so you got to be really careful about nomenclature and how you name the files. The alternative to that is that you build a more complex model that allows you to basically do the scenario planning in it. And I built some of those, but it's pretty intensive to make, and as far as I know, there's not really any freely available functions. Getting to Remy's comments, if there are any, you know, maybe not free, but economical software packages, they will typically allow you to do scenario planning as well.
And then I'm actually struggling to find comps for our company's segment. I'm just trying to have an understanding of what other early stage non-revenue med device companies are in our space, which is in pain management. What they've spent, how much have people invested? You know, I want to create you know, a grouping of these companies and look like, okay, these were acquired at year 3, these were acquired at year 6, just so I have a sense of, you know, the companies that came before me and what their experience was, at least from a analytical standpoint. I think it's good to share with an investor.
Yeah, absolutely. I mean, I will say that there's databases like PitchBook, which will allow you to see how much money people have raised. It won't tell you how much they're spending, unfortunately.
Right. That would be great.
Yeah, and that's something that companies kind of guard probably pretty closely unless they're publicly traded. I mean, the best case again is if you look at a publicly traded company that essentially only sells 1 or 2 products. You can, if you look at their financials, you can assume that all their expenses are related to that particular product. Yeah. Other than that, it can be challenging. I mean, I will say that if you can talk to people, and you know, this is kind of getting outside the scope of financials, but one of the things that I found really useful with the company that I started was I engaged a lot of advisors and actually didn't pay them, but gave them stock in the company. And a lot of them had the experience with things that I didn't. And so it helped with things like, you know, estimating timelines and costs for studies.
Got it. Okay. Yeah. Sounds good. Thank you so much, Randy.
You bet. Yeah.
All right. So thank you, Randy. Thanks for your very knowledgeable presentation. I think we all learned something new and got a lot of thought provoking. So let's give Randy a round of applause. Yay, hands and digital hands. So there's a couple questions in, we're gonna, like, this is our break. So if you guys have to bio break, then this is the time to do it. There are 2 questions in the chat, Randy, from Melissa from ASL Flurry and David.
Oh, yeah. Okay.
If you want to answer those. And there was a question, I don't know if Benton wants to come out of wherever he is. There's a question about the financial in Gust. Is there a template in Gust? I think in Gust there is
There is, yes.
spreadsheet. It's very primitive, but go ahead, Benton.
Yeah, you can, Gust is flexible. You can upload a more sophisticated spreadsheet or whatever your report is, which
Mhm.
is recommended, or you can type your numbers into their template, which is very simple. It's fine, you know, if you're pre-revenue and you're forecasting not much revenue for the next couple of years, like a lot of biotechs and startups are.
Yep.
It's fine to type that into Gust directly, and you know, the whole idea of Gust is to make it simple and easy for the entrepreneurs to connect with the investors. And then when you get into your data room, you can do whatever you like if you have more sophisticated P&Ls and projections. And there are some other, besides QuickBooks, you might look at Xero, Xero, which is a really low cost software program for accounting. It doesn't have a whole lot of forecasting, but it will do everything that QuickBooks does for less money. A lot of people are switching there.
Cool. That's awesome. Thank you, Benton.
Yeah, and
Yeah,
if you
thanks, Randy. Good stuff.
if you- the
Yeah.
first event, like if you do, sometimes founders, when they use Gus and they apply, they will fill out the very simple framework that Gus is like, it's just a table, you know, and people will do that, and then they will upload their real their Excel sheet, you know, with and they don't match, and that's awful. So if you are going to be changing your data a lot, or you're going to be just maybe just put it in one place, so you don't have that problem, but just make sure things match, because it becomes very confusing for people reviewing your file.
But I will say this about Gus, don't leave it blank, because when investors download the one sheet on your company, it will show what your forecasted numbers are going to be. And if you don't put anything in the template, it'll be zero. And that's probably not accurate.
Yes, so yeah, okay, so you're right. Use the template, but make sure it matches.
Yes, yeah.
So, all right, so I see Kit's got his camera on. We got 1 minute, so I will go ahead and do an introduction for Kit, because he is a great friend of the Brink. They sponsor the in-person pitch prep events. They help pay for that pizza, so hopefully you come next week and enjoy that. So, and Kit also has a legal office hours that he runs. I think it's every month. And if you are a registered client with the Brink, we can connect you, and you can book some time with Kit and get your questions explored. So, and then finally, of course, SDAC 7 is kicking off, and they've named the fund managers, and it's Kit, Ryan, and Amit, blanking on his name. Sorry, you guys. Who's the co-fund manager? All right, no, anyway, Kit, we'll just say Kit is leading the fund management team. So for SDAC 7, which is really important, because he's kind of helps runs the show, recruits investors. You know, you got to recruit, run your fund, build your fund, but then also kind of is very much involved with the founders and running the program there. So with that, I will introduce Kit Ryan from Pillsbury. He's an attorney, and go ahead, and the floor is yours.
All right, thanks, Amy. And it's Amit Argwal, is the fund manager for SDAC 7. And really excited to be doing this presentation. This is about, the topic here is really close to my heart and to my practice in law. And for a little bit more background on kind of my practice and who I am, I'm a corporate venture capital and M&A associate at Pillsbury. What that basically means is just a fancy way of saying I help entrepreneurs like you guys find capital, raise capital, and go through the entire life cycle process from a legal and really kind of business perspective. So if you're trying to raise money or sell your business or buy a business, we'll take you through that entire process. And I would say I'd specialize in startup law. And in particular, I advise on venture capital financings. So whether that's raising equity or raising convertible debt or actually debt instruments, that's kind of my specialty. So I've worked with lots of different entrepreneurs and lots of different transactions. And so I would say over the course of the last 2 years, I've helped entrepreneurs raise well over $2 billion in total capital during, the last 24 months. So with that, I will share my screen. I know I'm looking over here, but my presentation's on this side, so. Okay, can you see my screen?
It's, there it is.
Yes, okay. All right, so just kind of stepping back, the things that I'm going to try to cover today are really to go through the ask slide of a pitch deck, and kind of things like what are the critical items that you want to see there? What do investors care about? What types of financial instruments that you can use as part of your deal structure, which is a key part of the ask slide. I'm going to go through the various different financial instruments that you should consider. Really, just to preview, the two key ones are convertible notes and safes, at least for this stage, for your stage at least. And then I'll talk through valuation briefly, and then pro forma cap tables. And if I have time, I'll even just like pull up an Excel and we can go through how to build out a really quick pro forma and go through that process. Because I think that that's really important for entrepreneurs to understand. And it's so critical for deciding what type of financial instrument and what type of valuation cap. And it helps tie in the entire concept all together. So the first part here, the ask slide. The critical points that you really need to consider here is to make sure that your slide communicates how much money you need, what you're going to do with those funds, and how the investors are going to benefit. You really want to align your financial strategy, which Randy touched on, and his presentation was all about, with the actual expectations from the investor. And so what that essentially means is you want to tie how much money you're going to raise, when the timing of those capital raises, with the eventual return that's going to be generated for the investors. And I'll touch on that on the next slide. But the next couple points here are it's crucial to understand that there's different types of financing structures that will apply at different stages for your startup. So based on whether you're pre-seed, seed, Series A, or beyond, you'll be looking at different types of financial instruments. And the last thing I want to touch on here is just investors, they care about their risk, their return on investment, how much dilution they're going to have, and what their potential exit strategy is. And another thing for you to consider is who the investors are that you're raising capital from. If it's friends and family, maybe they don't care about any of this stuff and they're just trying to give you money and you want to just pay for something really quick, easy, and cost effective, maybe the safe is the right route. If you're going with an angel investor, maybe they care more about the timing of when they're potentially going to realize their investment. And certainly if you're receiving funds from a venture capitalist or other institutional investor, you want in the back of your head to think about the timing of their fund. So if they just raised their first or second or whenever fund, they typically have a 10-year time frame for when they need to return that capital back to their LPs. And they typically will do that between years 5 and 8. And so knowing that, and you can find out when their fund was created, but knowing that should influence how you pitch to them. So if it's been 3 or 4 years since the fund was formed, you know they need your you know that they need you to sell within 2 to 3 years from the moment of their investment. And so maybe that timeline just doesn't work for you based on where you are as an entrepreneur and where your startup is. And maybe you should be looking at other institutional investors. But either way, that knowledge will help you frame the timing of how this investment from the VC is going to turn into an ROI for them in the future. Kind of touching on that, so your ask slide should clearly articulate the amount of capital that you are going to raise, and you really want to align it with some business growth milestones in the future. So that can be various different things. If you're a biotech company, or you're in the healthcare space, maybe that's going through a clinical trial or getting you to a point where you can, or you're finished the first stage of a clinical trial. If you're a SaaS company, maybe that's the completion of the first development of your product and release of your product. So you really want to think runway, where's this money going to get me? And how do I articulate this to the investor in the actual slide and also when you're pitching to them generally? The other thing to think about is whether you raise all of that money as a single lump sum or through various tranches. It's a lot easier to pitch someone, hey, I'm going to be raising $500,000 versus I'm going to raise $3.5 million and that's my minimum. And so something for you to think about in the back of your head is to kind of backtrack from the various business growth milestones that will get you to a point in the future where you're either going to sell your business or you're going to be at a stage where you're generating enough internal cash flow where you have a sustainable business. Because that's the ultimate goal for most entrepreneurs, those two key milestones. And you need to backtrack using the stuff you learned from Randy's presentation by putting together your pro forma and understanding the financial side, and then get to the point where you get to today, and then that will project out how much money you need to get to each milestone and when you're going to raise future capital and so on and so forth. And so being able to articulate that to the investor shows credibility. It shows that you have thought through this process. You are actually going to use the money for a particular purpose. It's not just going to go and be wasted. And it allows you to show the growth trajectory and eventual ROI opportunity, whether that's IPO, sale, or something else for the actual investor, which is a much better pitch than simply saying, hey, I'm the SaaS business, I need $500,000 or $5 million, and I want to do it on a convertible note with no backing or rationale for it other than I heard that was a great number. And so you really want to have it builds credibility to have projected all of this out. And from all of the pitch decks that I've seen, and the entrepreneurs that I've seen successfully get term sheets signed and actual funds through the door, that's the strategy that they tend to implement. And it seems it is the successful and the best strategy I've seen. The other thing to think about too is to be able to articulate what you're going to use those funds for, not just projecting out, hey, $1 million is going to get me to the point where I'm going to have my product launch in 12 to 18 months, but actually breaking down what the use of those funds is going to be. I'm going to spend 40 to 50% of the $1 million raise on product development. And that's how much I need to get to that 18-month point where I'm going to have a product launch. And then at that stage, I'm going to raise a Series A. And you can really map out for them the growth and value in their investment by doing that. And showing here on this slide, 40% is going to product development, 20% sales and marketing, et cetera, et cetera. That just shows more confidence for your investor that the money that they're putting into your company is actually going to be used for specific purposes and that you've thought through this critically. Because at the end of the day, when it's a pre-seed investment, they're taking a significant risk by investing in your business, especially if you're an entrepreneur, a first-time entrepreneur without a strong track record of success. You really need to instill confidence in the investor in order to get those funds through the door. We talked a lot about the types of cash we haven't really talked about the types of investments that can be made here. And so the next thing that you want to have on your deal slide is how you're going to structure the investment, whether that's a SAFE, a convertible note, or a priced equity round. At this stage, it's unlikely that you'll do a priced equity round. That's typically saved for, later on when you're going to actually have institutional investors or do a Series A financing. You're really trying to decide when you're an early stage company, what type of convertible equity security or convertible debt security you're going to go with. And that's really just between the SAFE and the convertible note. And I'm going to go into detail about the differences between those two and later on in the presentation. But for your purposes, you just need to know early stage companies, it's really pre-seed or seed. And when you're more at the growth stage, that's going to be more Series A, Series B, and beyond. And that's where you're going to be selling equity, usually preferred stock for cash. So here it's just kind of like a breakdown of when you're typically in a pre-seed versus seed or growth stage, and that's going to be the next slide. And here it just shows the company focus for a pre-seed company is you're really just proving your idea. You're still, trying to build confidence, make sure that there's product market fit, there's customer interest, and that you're eventually going to be able to generate cash flow, but you're probably pre-revenue. Very few shareholders, your investors are friends and family, or maybe there's some angel investors here, and you're typically going to have a smaller investment amount of less than $1 million, and that's typically done through a convertible note or a SAFE. Now, when you get to a seed or really Series A, and there's a lot of terminology here between seed, pre-seed, and Series A and beyond. Really, pre-seed is just where you're going to be raising with friends and family and maybe angel investors through a security like a note or a SAFE. Series seed and even Series A, that's when you're really going to be targeting institutional investors, receiving larger checks like $1 million to $3 million, and selling actually preferred stock, whether that's Series Seed or Series A. One thing I don't touch on later in the presentation that I'll just talk about right here. Sometimes there's no difference between Series Seed preferred stock and Series A preferred stock. That's just sort of what's happened over the last couple of years. But before probably 2020 or 2019, 2020, Series Seed preferred stock typically was issued with lesser rights and privileges than what you'd see with the typical Series A. And so if somebody says to you, hey, I want to do a Series Seed investment in your company, well, what does that actually mean? Typically, the investors just mean, I want to do a Series A investment, get all of the information rights, registration rights, right of first refusal, the whole shebang, treat it as a Series A, but call it something else. And so it's just something to have in the back of your mind. It's more of a technical legal item, but still something to consider. So here it's just the growth slide. So in your Series A, you're kind of in this growth trajectory, product traction. You probably have 12 to 20 shareholders. You're bringing in employees, and you're really looking for venture capitalists and strategic investors. Your total investment amount is going to be 10, 30, 75 million for Series A, B, C. We just did a $150 million Series D investment that I closed 2 days ago. So, it can go all the way to D. We did a Series F last year for $200 million. And so it can go all the way up the alphabet. So I said a lot of terms and I threw a lot of information at you, but why does any of that stuff matter? And it really comes down to structuring the round, the type of deal structure, influences, and the valuation of your company that drives growth. And these are the factors that the lead investor is going to consider when they're determining what the value of your company is and whether they're going to make an investment. There's different influences at the different stages, and whether you're at a pre-seed or early stage, or whether you're in the growth stage, there will be different investment instruments, investment terms, sophistication of your investors, and level of diligence and valuation methodologies. And we're going to go into many of those next. So here, I'm just out, this kind of gives you an outline of the general venture capital funding process. This is really more important for a Series A investment, but it can sometimes come up even on a pre-seed investment, depending on how sophisticated the investor is and the size of the check coming in. So you might have a situation where you need $3 million in order to get to that 18 to 24 month mark where you're going to have your product launch. And you have an investor who's semi-sophisticated who only wants to, or who wants to do all of this on a convertible note or a safe. That sometimes happens. In that situation, you would still have a similar capital funding process here as you would in a Series A investment. And that really just starts with the initial negotiation or discussions with the investor. So that's the pre-term sheet to term sheet execution stage, where you're negotiating key terms, you're getting company counsel, you finalize valuations, and you actually execute the term sheet. And then there's going to be a diligence process that happens where the investor is going to want to see a data room that includes all of the different documents that the company has ever entered into or should have entered into, everything associated with your cap table, all of your financials. Basically, they're just doing due diligence on whether you are who you say you are, whether there are other investors out there or anyone else that has potential rights to capitalization in your company, whether you own your IP, and they want to backstop your financials by in order to quantify or qualify their investment in you. And so those are the things that you should consider now. And as you start thinking about going through the SDAC application process, you really should be putting your data room together, because let's say you get accepted through the first couple stages of SDAC. When you get to the final 6, or maybe it's the final 8, there will be due diligence done on your company, and you'll have to put a data room together. And I was involved in that diligence process last year, and I know that can be very stressful on the entrepreneurs who have never done that before. And so you really want to just start making sure you have all of your documents in place, that you're on Carta or some similar cap table management software, and that you are really just organized in general and have all of that in a single place like a data room. And that's really what this second stage of the funding process is all about, is due diligence. And then you've got pre-closing, closing, and post-closing. That's really just making sure your pro forma is correct, which we'll talk about later, executing documents, getting the money through the door, and issuing stock certificates and other post-closing items, which I won't bore you on. The next thing I'll talk about are the various financial instruments. And really, I'm just going to go through safes and convertible notes. So both the safes and convertible notes are really similar financial instruments in that they both are sort of quasi-debt, quasi-equity. Safes are closer to quasi-equity. Convertible notes are closer to quasi-debt. But in either case, they're an instrument that you provide to an investor in exchange for money. And what that provides the investor the right to convert that cash, or the cash value of that instrument, into equity at a future financing. So let's say somebody, there's an investment of $1 million, and in exchange, they give you a safe, or you give them a safe, and you go through a Series A financing 12 months from now. At that financing, that $1 million safe will convert into another class of Series A preferred stock that will be issued to the holder of that safe. And we'll talk a little bit about the conversion mechanics of that in the next couple slides. But that's the kind of overview, is you're giving them the right to convert into equity at a future date, not now. And so immediately after the SAFE is issued, let's say you own 100% of the business of the outstanding stock prior to the SAFE issuance, you still own 100% of the company after you've issued the SAFE. But now there's this looming right that they will convert into additional equity in the future, which will dilute you at that Series A financing. It won't dilute you immediately after you get the SAFE or you issue the SAFE. It will dilute you in the future. There's different types of SAFEs and different types of convertible notes. The most important thing, well, the first two I want to talk about are the pre-money SAFE and the post-money SAFE. Now, SAFEs were originally issued by Y Combinator, and you can find the form of SAFE, the various forms of SAFEs on their website by just searching Y Combinator SAFE on Google. It'll be right there. There used to be something called a pre-money SAFE. Now they're only issuing post-money SAFEs. A post-money SAFE just basically means that right before the financing happens, right before the Series A, the SAFEs will convert into a particular number of Series A preferred stock, assuming everything else in the cap table is outstanding. So if there's a valuation cap, they will convert at the price per share that's calculated using the valuation cap, the lower of the price per share calculated using the valuation cap, and the actual price per share of the preferred stock sold in the financing. So if, let's say there's a valuation cap of $10 million, there's 10 million shares of common stock outstanding right before the financing, the SAFE will convert at the price determined by the valuation cap of 10 million divided by 10 million shares of common stock plus the number of shares of SAFE preferred that's converted. So a post-money SAFE actually creates when there's additional SAFEs that are issued and outstanding or other convertible instruments, those SAFE preferred that are converted from them do not dilute each other. So if you have $1 million that you raised on a SAFE on a valuation cap of $10 million, the SAFE holder will receive 10% of the company before accounting for the new money preferred stock that gets issued, no matter what. So if you issue multiple SAFEs, so you raise one SAFE at 1 million, 10 million cap, and you issue another SAFE at using the same terms, they will get 20% of the company and you will be diluted down to 80%, all before accounting for the new money investment from the Series A investor. And so it's really important to understand that and the implications on the cap table with the post-money SAFE, because I can't tell you how many times founders have been shocked about the total dilution on them because of the results of the various SAFEs that they got prior to a priced round. And so really the key concept to understand here is don't just continuously issue SAFEs without thinking through critically about the impact on the cap table. Because if it's post-money, that means the various SAFEs don't dilute each other and they only dilute the founding team. So just always remember that. It's very crucial. If it's a pre-money valuation cap, and that's typically what convertible notes are issued on, that means the additional convertible notes or the additional pre-money SAFEs will all dilute each other, as well as diluting the initial founding team. And so there's a little bit of shared dilution there that can actually add up and be very significant over time, depending on how much money you raise. The other type of SAFE or really convertible note is where they convert based off a discount rate. A discount rate will typically be anywhere between 15 to 25%. The most common is 20%. And what that means is the conversion price for determining for the price at which the SAFE or convertible note will convert in the future financing is just 1 minus the discount times the price per share of the new money preferred. And we'll go into an example later to help kind of articulate or show how this all impacts the cap table. But the last thing to note here is it's very rare to see a SAFE that has both a valuation cap and a discount. It happens. Y Combinator used to have that, but now it's pretty rare to see that. You see that more often with a convertible note. There are significant advantages to the SAFE for entrepreneurs, and that the main thing is that they're very quick, simple, and cost effective. You don't really need to even hire an attorney to go through and issue a SAFE. You just need to sign the document, get the cash through the door. That's the whole purpose of the SAFE. But what has happened is investors will modify them and try to negotiate various terms that are outside the norm. And so my advice to all of our clients is always just to push back and just always execute the exact SAFE that's being issued by Y Combinator at the time. It's cost effective, it saves you money, and you know all of the terms that the SAFE will be on. Otherwise, investors tend to include various additional rights and preferences and other requirements that you just typically don't see, and it just defeats the whole purpose of the SAFE. And then you might as well have done a convertible note or entered into a term sheet that dictated all of the different terms that you're going to agree to. The other advantage of the SAFE is that it provides the investors with shadow preferred. And shadow preferred just means that they will receive a price per share or liquidation preference that's based on the actual money that they have invested. And so this is really important because one of the disadvantages that I'll talk about later with the convertible note is that they don't receive shadow preferred generally. They generally will have the same liquidation preference as the new money preferred stock, which creates this windfall for them that's in addition to the amount that they initially invested. The disadvantages of the SAFEs are there can be, if there's multiple SAFEs, it can have serious dilution on the founding team, like we talked about before. And if there's varying valuation caps, it can create significant conversion complexity and really complicate your pro forma cap table. The other thing to really consider and be aware of is in addition to these standard Y Combinator SAFEs, there are side letters that investors will ask for, which include additional rights like pro rata rights to purchase in future equity issuances or equity raises, and information rights, and other types of protective provisions and consent requirements. These types of rights are typically given to preferred investors in an actual priced equity round, like a Series A financing, and sometimes a Series C financing. So when an investor asks for things like this, it's outside of what's typically given at the pre-seed and early stage company at that moment, or what's typically given at that stage for those types of investments. And so you should, my advice is always to push back on things like this, especially information rights. The types of information rights or the things that are required there are typically, quarterly financial statements. Sometimes they're audited financial statements. Sometimes you'll see inspection rights where the investor will be able to come in and invest and look at your books and records and other important like critical information that the company has. Sometimes you'll see board observer rights that are requested. These things are onerous and can really create issues for entrepreneurs who are just, not at that stage where they're going through and having those available. And so you just want to be aware of that and really avoid entering into any of these side letters. But at the end of the day, if you need the money, you're at the whim of the investor. It's just something for you to negotiate with the understanding that this isn't something you should just give up for no reason. And so be aware of that going in. So for the convertible notes, the key differences, or I guess the key structures, other than the fact that it's money that eventually will convert into equity in the future, are that there's an interest rate. Typically, you'll see anywhere 5 to 8%. There's a maturity date. So at some point in the future, an investor could demand repayment of the convertible note. There is no maturity date for the SAFE. And so, there is an argument that the SAFE is more company favorable than the convertible note, and that tends to be true. But investors these days actually prefer the SAFE investment instrument for some reason, but in reality, the convertible note is actually more favorable for the investor. And so it's kind of a strange paradigm that's happened over the course of the last few years. But again, no maturity date on the SAFE. There's 18 to 24 months of maturity for the convertible note. The one other thing I'll add there is that the maturity date is kind of a facade, because at the end of the day, the investor needs you to be successful in order to get an ROI on their investment. They could demand repayment and put you into bankruptcy, but that sort of defeats the entire purpose of making the investment. They know it's a high risk situation. So at this stage, it might not be something to care about. At least that's the general guidance that I give our clients. You'll see that they have a discount rate and evaluation cap, just like the convertible note. One other thing to think about here is there's typically a change of control premium. So if the company is ever sold, the convertible note will be at the top of the stack when it's sold, meaning that they're going to be paid out prior to the preferred stock in the liquidation waterfall because they're treated as debt. The SAFE is typically not, before the preferred. It's usually paid out along with, or sometimes immediately after, but prior to the common stock, prior to when the founders get the money in the liquidation waterfall. So the convertible notes, tends to be worse on the investor or worse on the founders in terms of what happens when the company is actually sold, if there's a sale prior to an equity financing release. So this slide, we're just talking about why is a convertible note considered debt versus like a SAFE. And that's really just, there's an interest rate, there's a maturity date, there's also default events. So usually those are tied to going into bankruptcy or incurring additional loans without getting consent, things like that. And so that provides the investor in a convertible note with opportunity to have like default interest where it's going to accrue at a higher rate, or call the convertible note and require the company to repay that. But again, that's kind of a low-level issue that typically just doesn't happen. We've already talked about this, so I'm just going to skip over that slide. The advantages of the convertible note, similar to the SAFE, are they're fast and cheap. And at least in comparison to a full priced round, they will typically convert at the lower price. So they offer early stage investors some upside potential. But one of the key disadvantages of the convertible note is that there's no shadow preferred. So if there's a Series A financing and the price per share of the Series A was $1, and let's say the convertible notes converted at 80% of that, so at 80 cents, the convertible notes will still get $1 of liquidation preference. That means that there's a 20 cents per share that the investors didn't pay for initially, that gets paid out to them before any money gets seen by the common. And so you're creating this windfall for the convertible notes that provides them more money in a liquidation for the company before anything gets seen by the founding team, which can create some frustration and even situations where everybody else gets paid out, but for the common stockholders. There's other provisions that you should think about, and these are similar to what you've seen in the side letter. The only one that I'll point out here that's also important is the MFN provision. This is another thing that gets negotiated often at with the SAFE. And that basically just means, or stands for most favored nation. And this is something that you should absolutely try to avoid and do not just agree to willy-nilly. If you see an MFN provision, you have to really consider whether you want to accept it. What it does, it is if you ever issue another SAFE or convertible note in the future that has a better, that has any better terms than the ones that contains the MFN provision, that note automatically gets amended and adjusted to include those more favorable terms. What's really the main problem here is where you issue a convertible note that has a lower valuation cap than the one that you initially had with the MFN. That's the situation that creates the big issue. So if I have a convertible note with a $10 million valuation cap, it has an MFN provision in it, and later, for whatever reason, the company's not doing well, I provide a new investor with a $2 million valuation cap. The one that I had issued before at $10 million gets reduced to $2 million. And I've seen this, I've had clients that, despite what we said to them, agreed to include an MFN provision. Later, this exact scenario happened, and the dilutive effect was just egregious for them. It pretty much wiped them out of the cap table when they eventually converted at their first institutional raise. So it can have significant effects. This table just kind of outlines the various features that we talked about in comparison to the SAFE and the convertible note. I included this just for you to look at in the future, because I know the slides are going to be distributed. It's a helpful comparison between the two. But you can see here, at the structure level, SAFEs are more equity-like, convertible notes are debt-like, SAFEs have no maturity date, convertible notes do, and so on and so forth. So you should refer back to this when you're trying to decide between the two. The last thing to touch on here about the equity securities or the financial instruments for your ask slide is, what about typical equity? And that's really just raised for larger financing rounds and when you're actually going to be ready to issue preferred stock. And one just quick point about the difference between preferred and common stock. Preferred stock is just another form of equity, but it includes various rights like liquidation preference, various voting rights, and anti-dilution protection. It also includes registration, pro rata rights, and other things that are granted to the preferred that's not typically held or given to the common stock. These rights are important, and they have significant impact on the control and governance of the company and the cash flow at a liquidation event. And so these are really important considerations when you're going into an institutional raise, and not really something to talk more about at this stage, since most people are at kind of the pre-seed early stage for their companies. The next thing we'll talk about is valuation and capitalization. So really pro forma and how to value the company. And at your stage, when you think valuation, well, let's step back for a second. One of the other reasons why you issue a convertible note or a SAFE is to avoid the valuation discussion, right? Because it's very difficult to value your company if you're pre-revenue, or if you're just so early stage where there's nothing really to quantify. And so you go with a convertible note or a SAFE investment in order to avoid that discussion, because when you do your first institutional raise, the new money investor will need to set a pre-money valuation for the company, because that will be one of the determinative factors for what the price per share of the new money, what they will pay for their investment. With the convertible note or the SAFE, the only thing that you really need to care about with respect to valuation is the valuation cap. And if that's too intimidating for you, and almost always my suggestion to my clients is to default to just offering the discount rate in lieu of a valuation cap. 99% of the time, the discount rate would have been better for you, or if you had converted, or if the note had converted, or the safe had converted based off a discount rate versus a valuation cap at your first financing, that would almost 99% of the time result in less dilution for the founding team than it would have had it converted based off a valuation cap. Almost always, but that it depends on various factors, but at least from my experience, that's been the case. And so it also allows you to avoid the valuation discussion altogether, because you can just say, I'll offer you a 80% or excuse me, 20% discount rate with no valuation cap. But investors don't like discount rates. They prefer valuation caps. And so if you do have that discussion, you need to understand, or you need to come up with a strategy of how you can value your company in order to justify a higher valuation cap. And in terms of how you would do that, there's various different valuation methods. And for early stage investors, it's typically qualitative elements like management experience, whether there's actual revenue, if you're pre-revenue or post-revenue, the viability of your product market fit, things like that. If you're kind of at a later or growth stage, maybe you could use something called the valuation or the venture capital method, where you're able to project what you would sell at the future and discount back to the present value or today. And maybe if you're at a later stage, you do something like DCF or discounted cash flows or comps, something like that. But for your purposes, you should really just be trying to figure out what valuation you can justify, and thinking about, okay, what's going to be the value of my business at the time of when the notes or safes are going to convert. And ideally, you'll have, using the stuff that you learned from Randy's presentation, you'll have financials that you could justify where you have cash flow, or you have potential revenue or customer base or clicks or eyeballs, whatever it is that you could use to justify and hopefully quantify the value of your company based off that point in time in the future, not based off today. Because today doesn't matter for purposes of the valuation cap. The only thing that matters is what you think you're going to be valued at 18 months from now, when that note or safe is going to convert at that financing. And so that's the thought process you need to have in your back of your mind, while at the same time thinking, I don't want to put a too high of a valuation cap where I'm scaring investors. This is something actually that happened at the last SDAC, where there was one company, everybody was gung-ho on it, very interested, but the entrepreneur was very adamant that they had like a $50 million valuation cap, which is, okay, it's kind of, it's a really high, it's not considered market, something that's the most general valuation cap is around $10 million, but a lot of investors will push further down and down so that they get a larger percentage when they convert. And so you just need to be able to justify the cap that you're going to offer to them. Understanding your pro forma will impact the your analysis and understanding of what to offer for a valuation cap. And so you need to be able to go to Carta, export the Carta summary cap table, and do some calculations to determine what would happen to your ownership percentage if you issued a convertible note or safe based off a X dollar cap or X% discount rate. That's something you need to be able to understand and do. It's not that complicated, especially if you have a really simple cap table. One thing to really understand just for the future, when you eventually do an institutional raise, your option pool. Investors will often try to negotiate a upsize to an option pool, and that's really just another mechanism that allows them to cram down the pre-money valuation that they're offering. And so you really should consider that and try to come up with an argument of why that percentage should be lower, or create an option pool ahead of going into that financing and make the argument that you have enough available to meet future employment engagement or hiring needs, rather than actually upsizing the pool like they are offering. And the last thing here, just to point out, investors, they really care about the conversion terms on your convertible note or your SAFE and the timing of when they're going to get equity. They care about dilution. So they're going to negotiate for a post-money cap rather than a pre-money cap. So you need to understand that going in. And they want to see, liquidation preference and a return on their investment. And so having that timeline for when they're actually going to get that raise, or where you're going to get the raise and then eventually lead to an exit opportunity is crucial for encouraging people to invest in your companies. All right, that covers everything. And I don't think I have enough time to go through live creating a pro forma, but Amy, you let me know.
Yeah, well, we can always do a part 2. I know you and I were talking about a legal readiness series, so we could move it to that. But we do have time for questions. So if you guys want to ask some questions, you just raise your digital hand. We'll see, we got some in the chat, but it's easier if you just raise your hand so we can dig around in there. Anyone got questions for Kit? How long does it take you to go through that part, pro forma? Oh, here we go. Was Melissa raising her physical hand? Yeah, go ahead. You have to unmute.
I was looking for my hand and I couldn't find it, so I just like stuck my hand up in the air. Hi, Kit. Thank you very much, and Randy also, and Amy. It's good to see you all. Thanks for all of the information. I did write my one question in the chat, but I'd love it if you could just help me a little bit more. How do you come up with the appropriate discount rate, and at what point would you like toe the line and say, no, valuation makes a lot more sense for my particular situation?
Yeah, that's a great question. It's going to be very difficult to get anything with respect to discount rate. 20% is almost always the case. You can try to fight and get do something lower, like 15%, but in terms of the impact for you versus the likelihood of that scaring investors away, I would almost always just say go for the 20% rather than anything else, and see if you can just get them to agree to a just discount rate over valuation cap. But if you're towing the line and you have to go with a valuation cap, or they're pushing on it, at the end of the day, you're really subject to the investor's decision, and until you have more negotiating leverage, it's tough to argue against them. So sometimes, and this is almost often the best strategy, is just to raise less money, get a better value at even a lower valuation cap, because in terms of the impact to your cap table, it will have the same effect as having a higher cap.
Great advice. Thank you so much. I appreciate it.
Yeah.
All right, and so we have Hari, who raised his hand. Go ahead.
Thank you. I have a 2-part question. The first one is very simple, just to make sure I understand. You recommend safes and not convertible notes and all that mess, but keep exactly the same terms for all the safes using Y Combinator. Did I get that right? Or did I miss any nuances?
Can you repeat the beginning of your question? Sorry.
Okay. So in terms of safes,
Yep.
if I keep exactly Y Combinator, I keep exactly the same structure for multiple safes, for multiple angels.
Yep.
That is preferred than all the other options that you described. I just want to make sure that I got your gist right.
So that's not actually what I would say is my general advice to entrepreneurs.
Okay.
If you're going to just issue one safe and rather than multiple safes, that would be the best strategy. Just use the Y Combinator post-money safe. But if you're going to have a series of investments, or maybe you're going to raise additional capital over a period of time, what's actually best for the entrepreneur would be to use a pre-money valuation cap for a convertible note, because it will have a lower dilutive effect on you personally and the rest of the founding team.
Okay, I need to digest that. The second part of my question is, I'm getting a hint of pre-funding cap and post-funding cap. Let me explain. If the startup was, let's say, spin-off from a university that had 10 million grants from NIH, SBIR, so on and so forth, I had 10 patents. That would account for the valuation before my first SAFE or first convertible note, correct?
The pre-money valuation,
Yeah.
would account for everything. So the pre-money valuation that a new money investor at your Series A or your first institutional raise will effectively include everything that's convertible or outstanding for the capitalization of your company, including any convertible securities, any safes, any convertible notes, any increase generally to the option pool. All of that they'll bake into there.
Yes, and you said that could be very large, and entrepreneurs could make a mistake of pushing that early on, like what happened last year at SDAC. The question was, for the safes, if I wanted to use the money that went into the concept, the prototype, the patents, the money that came in from grants, can I use that as a leverage when I go with my first safe to my first angel?
Yeah, I'm sure you can use that as leverage, but it's not leveraging that the fact that you have access to capital. I wouldn't use that as a leverage point against them, rather than as a point for you to understand that you can get capital elsewhere, and maybe even lower the total amount that you'd raise on the safe, just because that's non-dilutive capital that you're talking about, and something you should consider before going for something that's potentially or will be diluted in the future, like the safe.
Thank you very much. I understand. I think I understand.
All right, you can always book some office hours with Kit. So next up we have.
Thank you. I will do that.
Yes. And you should if you get the email from Natalia Pence, she's the one that handles that. But if you just email us and we'll connect you. All right, Chris, you're up.
Hey Kit, how's it going? We met a couple times, the founder of About Scout, the fighting app.
Oh yeah. Good
Yeah.
to see you again.
Hey, nice to meet you. Or sorry, not nice to meet you, sorry. Multitasking. Anyways, so with the safe note, so I just have a question because Jackson Wink, the gym, they are looking at to potentially be an early investor, and we were looking at safe agreements. But my worry is that they are not an accredited an accredited investor, I believe. So do people have to be accredited in order to invest in your company or within the safe agreement?
Yeah, that's a great question. So the safe is a security, just like any other, just like the convertible note, just like actually issuing or selling equity in your company. That means it's subject to securities laws, and that means that it either needs to be registered with the SEC or an exemption applies. One exemption that everybody defaults to is issuing equity to accredited investors. Now, that isn't the only exemption. There's various others. There's, a Form D filing that can be made for, some equity or security issuances where some of the recipients are going to be accredited, others are not. For your purposes, for the company's purposes, and my general advice is there's going to be a representation in the SAFE agreement that says that the recipient is accredited. You don't necessarily need to do your due diligence to confirm that. There's some reasonable requirements that you've done things like include a rep that says they are. And unless they give you some sort of definitive or specific reason why you think that they aren't, then to just leave it at that. That's usually my general advice for it.
Is that the loophole in that, pretty much?
I wouldn't say it's a loophole. It's just, they've provided to you and they're saying they are accredited based off the agreement. They're repping to that. And you don't have an obligation to confirm that. You've already done enough of your due diligence by putting that specific rep in there.
What are the legal repercussions to that? If, for example, I think they are accredited, but for some reason they're not.
Well,
for whatever reason that may
if you're
be.
really concerned about it, I would just encourage you to file a Form D filing. And that will protect your downside. But the legal repercussions of issuing securities that should have been registered, but that they weren't, are that the actual issuance is deemed not to have happened.
Okay.
All right, any other questions? We're a little over time, so thank you everyone for coming. We'll close it there, and we will to be continued with Kit in our legal readiness series, which will happen in the future, probably after SDAC. So be ready on the lookout for that. And so I just want to thank, of course, our speakers, Randy and Kit, for taking the time, sharing their knowledge, and answering all these questions, and just being dedicated to founders. So let's give them a round of applause. Thank you for coming out. I wish we were in person so we could hear it. So with that, you guys enjoy the rest of your evening, and I will see you at next week's event. Next Wednesday, we're going to be talking about competition in IP with Misty Kane from Techstars and Noel Gillespie from Procopio. We'll have pizza there from Pillsbury. So hope to see you there, and have a great evening.
Amy, is there any homework for us for the next face-to-face meeting? Because